Welcome to the Stock Market Palantir. Today we are going to talk about INHD. So, INA Holdings Inc., or INHD. This is, I think, a quintessential example of a modern event-driven microcap. It's a fascinating small entity, right? It's sitting at around a $9.4 million market cap, and it has undergone this radical, almost instantaneous strategic change. We've seen them go from cold-formed steel manufacturing, a very stable, low-margin business, to high-volume electronics trading, and now, the big one, a leap into the speculative world of Web3 and blockchain.
And that pivot, that jarring change, is exactly what's behind the extreme volatility we've seen. I mean, the stock surged up to, what, $1.39, only to get smacked right back down to around 70 cents. So the central conflict, the vital question for anyone looking at this, is whether this sharp price action is reflecting genuine growth potential, or if it's just the mechanical output of a company that's desperate to raise capital just to survive.
Right. And for me, I'm really focused on the tactical play here. I see INHD as a high-velocity, event-driven trading vehicle. My whole thesis is that it offers these significant tactical opportunities because of the density of news catalysts and, of course, the very tight float dynamics. It creates these spikes that sophisticated traders can exploit.
See, I'm on the complete other side of that. I'm holding a structural bear thesis. I just see INHD as fundamentally compromised. In my view, the company is basically a dilution machine where this overwhelming need for capital just fatally compromises any real long-term fundamental upside.
Well, my thesis really hinges on this idea that the stock is pricing in a speculative future. It has completely decoupled its valuation from that old legacy steel business. I mean, the market is obviously reacting to the November 2025 Megabyte Solutions MOU, right? The one that's supposed to deploy Web3 tech into their B2B marketplace. And that narrative shift is just incredibly powerful. It lets the market slap a tech premium on it, which instantly elevates the perceived value. And you can see the groundwork for it. I mean, look at the recent performance. They posted staggering top-line revenue growth, something like 787% in the last 12 months. That wasn't from selling steel beams. It was almost entirely from the pivot into electronics trading. So this tells me you have a management team that's actively changing the business model.
They're getting really good at creating this high-frequency news flow to attract liquidity, which, let's be honest, is a strategic necessity when your legacy business is dying. For people who are risk-tolerant, this creates predictable, exploitable spikes.
I'm sorry, I just don't buy that this volatility is anything more than a facade covering systemic structural decay. Look, the single most important force governing this stock, the one thing that overrides all the talk about Web3 and revenue growth, is the $50 million at-the-market offering, the ATM. That was authorized on November 13th. That ATM is the anchor that's weighing this whole thing down. And you have to understand the scale of this thing, $50 million. That's about 530% of the company's current market cap. If they execute that at, say, 70 cents a share, we're talking about issuing over 70 million new shares. The current public float is only about 5.15 million. This would just completely inundate the existing shareholder base. This isn't funding growth, it's a company fighting for survival by sacrificing its own capital structure. And it's a pattern, right? They did that 1-for-10 reverse split in October 24 just to stay on the NASDAQ, and of course, it failed to hold the price. It's all just short-term tactical fixes. So let's dig into that first point, the integrity of this corporate pivot. I just want to challenge how feasible this really is. The operational chasm between making steel frames and, auditing smart contracts is immense. There is virtually zero operational synergy there. And this Megabyte Solutions MOU, it's filled with all the right keywords. Blockchain-based logistics, decentralized marketplace. But when you do even a little digging, the partner has no significant digital footprint. To me, that strongly suggests the partnership exists to validate a narrative, to get that tech premium you mentioned. It feels like a textbook case of narrative economics substituting for actual boots-on-the-ground business execution. You can't just turn a factory into a blockchain node overnight.
Okay, I see why you think that, and I agree. Skepticism about the operational synergy is warranted. I'm not going to argue that. However, I'd frame this pivot differently. I don't think it's just a greedy move to punk the stock. I think it's a strategic evolution that's driven by the pure necessity of survival in a really hostile microcap world. The CFS business was, as you said, it was unsustainable. And if you only focus on the Web3 leap, you're ignoring the critical earlier pivot, the September 2025 Starlight Telecom MOU. That move was aimed at actual physical expansion into the Middle East, Europe, Africa, through electronics trading. So that shows a real effort towards supply chain change before they even tried the Web3 thing. These are sequential moves, and they are legitimate attempts to secure a higher multiple to escape the industrial sector's valuation trap. And yes, MOUs are non-binding, but they function as market signals, and these signals are working. They're attracting the liquidity INHD desperately needs.
But that liquidity is being pulled directly from existing shareholders. That's the inescapable reality. The strategic necessity you're describing is being funded by dilution. That $50 million ATM is the structural headwind that turns every hopeful spike into a trap for retail traders. This is the definition of a death spiral in microcap finance. I mean, think about how it works day to day. Every time retail traders pile in on good news, the sales agent, Aegis Capital, is empowered to sell newly created stock right into that volume. It acts as this invisible sell wall that just sits over the market. It caps the rally, it absorbs the buying pressure, and it distributes new paper to unsuspecting holders. And this isn't optional. It's essential for their survival, given their cash runway is only about $4.4 million, and they have a consistently negative EPS. The company needs this capital to stay solvent, not to fund some grand Web3 vision.
That's an interesting point on the death spiral, though I would frame its effect a bit differently. I'm not convinced that reasoning fully captures the utility for a momentum trader. I mean, the ATM, while yes, it's absolutely a long-term headwind, it also creates the precise volatility and, more importantly, the liquidity you need for short-term tactical trades. The ATM guarantees high volume churn because the actual flow is so small, just over 5 million shares. Any big news catalyst forces this massive rapid spike. Then, the ATM sells into that spike, absorbs the demand, and basically resets the price for the next news cycle. If your timeline is measured in hours or days, the ATM provides both the liquidity to get in on news and the churn you need to get out profitably. You see it as a destruction mechanism. I see it as an engine generating tradable opportunities. And on top of that, you have the retail momentum. We're seeing classic signs of the discovery phase of a meme cycle. I mean, the stock is getting a ton of attention, picking up these high-velocity sentiment markers in trading communities, things like Pineapple Bombshell and Juice Alert. This momentum, it's driven purely by attention and narrative, and it can temporarily just completely override fundamental valuation. These companies trade on buzz, not on EBITDA. And management is expertly feeding this engine with high-frequency announcements, which creates predictable liquidity spikes. If the story is good enough, the market chases it. That's the opportunity.
That's a compelling point about retail flow, but have you looked at how that flow is being managed by the pros? The microstructure data, it suggests that this retail buying is being actively neutralized by market makers. You have to look at the dark pool data. The daily off-exchange short volume ratio is anywhere from 13% to over 40% on active days. So this behavior suggests transactional shorting. The MMs are basically soaking up the retail buy orders by internalizing them through the TRF volume. So when a retail buy order comes in, instead of it hitting the public exchange and pushing the price up, the market maker just takes the other side of it, neutralizes its force, and then shorts the stock to hedge. This acts as a damper. It converts explosive price moves into high volume churn, which makes it easier to facilitate the ATM sales. And here's the kicker. The actual documented short interest is incredibly low, like 1.89% of the float. That just completely debunks any kind of short squeeze idea. This confirms the short volume we see is just transactional liquidity management. It's not directional bets. The deck is structurally stacked against any kind of sustained rally.
Okay, yeah, that distinction between structural short interest and transactional short volume it's essential. I agree completely. The MMs are acting at a damper, creating a ceiling. But it's precisely this controlled volatility environment where news creates a spike and then the ATM and MM hedging cap it that defines the trading opportunity. The volatility is predictable.
So we can converge on that point then. INDs is basically functioning as a volatility derivative, not as a construction company or even a real software developer. Its short-term price is completely divorced from the book value of its legacy business.
Right, so to summarize my position, while the structural risks from the ATM are undeniable, INHD's proven ability to generate narrative catalysts combined with its low float offers very specific high-risk trading opportunities. For a short-term trader, you have to view the position as like an option premium on the next news spike and accept the binary risk.
And I'll reaffirm that the structural gravity here, the $50 million dilution, the history of reverse splits, the mathematical certainty of their need for capital, it all heavily favors the downside over any multi-month time frame. The company exists first and foremost to convert press releases into trading volume, which then gets converted into capital through the ATM. It's a capital-raising machine disguised as a tech pivot.
INHD is, without a doubt, a remarkable case study in this kind of event-driven microcap volatility. It really highlights the huge disconnect between fundamental book value and speculative market pricing that's driven by these ambitious Web3 narratives.
Yeah, our discussion really illuminates that success in this stock depends entirely on your timeline and your risk tolerance relative to that constant threat of the ATM. If you're long, the risk is fatal. If you're in for a few days, the catalyst density is attractive.
So we have analyzed the dual nature of INHD, contrasting the short-term trading opportunity driven by Web3 narratives and high volatility against the long-term structural burden of the $50 million at-the-market offering and historical dilution.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.